This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 4 videos on trading major trend reversal tops. I think it's important to understand that when you take a swing trade, usually the probability is low initially, especially for a major trend reversal type top, which is within a trading range. If you want a higher probability trade, you enter after there is a strong breakout, but at that point the stop is further away, so the risk is greater. Traders always need a plan for taking profits when they enter a trade. This is a daily chart of the US dollar versus the Canadian dollar, and there's a bull trend and then sideways to the moving average for 10 or 20 bars, decent selling pressure, and then a higher high that reversed down, a micro double top, second entry short, first entry, second entry, triangle, final flag, a reasonable short for a higher high major trend reversal. But the market's still in a trading range. It's attempting to break above the top of the range and it's failing, but it's still in a trading range, and therefore selling a reversal down for a swing is still only a 40% bet. Some traders do not like taking low probability trades even when the risk is small. They prefer to wait until the probability is higher, and that means they like to wait until they see a strong breakout. For example, a pair of consecutive big bear bars closing below the low of the trading range, especially if there is a follow-through bar, a second bear bar closing below the low of the trading range. At this point, when you see 3 consecutive bear bars like this closing on or near their lows, there's a 60% chance that you're going to get some kind of a measured move down, maybe based upon the height of the bodies, the open of the first bar, the close of the third bar. Here you can see it did not reach the measured move down, but that's a reasonable expectation. Also, you might simply get a measured move down based upon the height of the trading range, or the height of this double top, or the height of this double top, which would be around here. The traders got a second leg down, which was likely after a strong breakout and consecutive closes below the trading range. First leg down pullback, second leg down, and the second leg down had a few small pushes down. What do the bears do? They thought it was going to fall for at least a measured move down based upon the height of the breakout, which is here. And now we have a second leg down, 1 pullback, 2, and now the second leg down has a wedge. You want to call it a triangle. And now there's a bull bar closing above its midpoint. Well, the premise has changed. At this point, it looks like we might be forming a trading range, and here we are in a small trading range. It's reasonable for the bears to exit on the reversal up above this bar, betting that it's in a trading range. If they get some kind of a double top, they can sell again for lower prices, but they're afraid that it might be the end of the move. Spike pullback channel, we may test this high, and we may get back above the bottom of the trading range that we had earlier. In fact, it's reasonable for the bulls to buy here as well. They have 3 pushes down, the bottom of a trading range. It looks like the market's starting to go sideways. It's reasonable for them to buy for a scalp. This is not really a major reversal. The channel here is very tight. It reversed up a lot, but most traders taking this buy are not looking for a swing up. They're looking for a trading range. In any case, the bears who sold for any reason, either up here or down here, now that we have a spike pullback channel and 3 attempts to reverse up with a decent buy signal bar, will take profits here. They're buying low in what they think might be a developing trading range. Bulls are buying low as well, looking for at least a scalp up to the top of the range and possibly a swing up. When you have a potential top, the reversal entry is the earliest swing entry, selling here, selling here, selling here. Once you think a reversal top might be underway. You can sell at any time. You don't have to take these entries with stops here or here or here. You can just say, well, all through here, there's a 40% chance I'm going to get a swing down. If I sell here, my stop is here. If I sell this close or below this bear bar or below this bar, my stop is here. If I sell here, my stop is either here or here. If I sell here, my stop is either here, here, or here. It doesn't matter where you sell or for whatever reason you sell. If you're holding for a swing trade, you're looking for a breakout and a measured move down. It does not matter where you enter or for whatever reason you enter. A reasonable stop is above the top of the strong bear breakout, and entering late can be just as good as entering early. A lot of traders worry about, oh my gosh, I missed the first entry and therefore I'm stuck. I'm trapped out. I can't get short. That's wrong. If you see the first entry, let's say somebody took this first entry and they held short relying on their stop here. That is exactly the same as you missing the first entry and selling at that same price or selling for any reason. Your entry has nothing to do with your stop. Your stop is based upon the price action, the top of the strong reversal down. And it does not matter if you entered here or if you entered for any reason in here. It's the same trade. And let's say you sold here and did not get out here. Then you're still short here. It's exactly the same as being flat and selling right here. Your entry location does not matter. All that matters is your premise of a swing down and your stop. Therefore, someone selling here has exactly the same trade as someone selling here or here or here. This is a strong enough breakout to expect at least a couple legs down and a measured move down. This bar, especially the follow-through bar with it, represent bulls giving up. They're giving up on their premise that this is a big bull flag and they'll get trend resumption up. They're now deciding that it's a trading range and we're getting a reversal down. So bull trend, trading range, reversal down, and we should get at least 2 legs down. The bears are selling as well. They'll either sell on a stop below the range on this close or on the follow-through close or on the reversal up, betting that the first reversal up will be minor and therefore become a bear flag and lead to a second leg down. Bears will sell closes. They'll sell above reversal bars, betting that the reversals are minor and that will go at least a little bit lower, especially when the reversal bars are weak setups. We have a small double bottom, but not enough bars for a major reversal, and the small bull bar is too small to reverse these 2 bigger bear bars. Here we have another double bottom, but a bear body and 3 consecutive bear bodies, probably a minor reversal and a trading range, or a bear flag and not a major trend reversal. Bears will sell bull reversal attempts, betting that they'll fail. Traders will also sell below bear flags. We went up and they'll sell below this bar, although one short, or better, below a bear bar, below a bear bar, below a bear bar, looking for at least a little bit more down. Bear breakout, first push down, second push down, third or fourth, or you can look at it as a nested wedge. A bear breakout and first push down, second push down, and third push down, with a third push subdivided into a wedge as well. First, second, third. So a smaller spike pullback channel. Whenever you have a top, a trading range top, traders look for a measured move down, and we're around the measured move target. We're not quite there using the top of the range and the bottom of the range, but if you used this double top and this neckline, the measured move would be about here. So for some computers, this is at a measured move down. For computers that use the entire trading range, we're near a measured move down, and we 3 times tried to get to the target and reversed. And therefore, traders will start to buy back their shorts, and bulls will start to buy as well. For the bears, it's reasonable to take profits here. If you took the very first entry, you exited with 743 pips for the higher high major trend reversal. If you took the lower of the two lower high major trend reversals, you had over 500 pips profit. Again, this is a daily chart. Exiting with 500 pips profit over the course of 2 or 3 months on the daily chart is not something that's unimaginable. I exited a trade today with over 500 pips profit in the euro versus the dollar. When you're trading on the daily chart and you're looking for a swing trade, that's what you're expecting. You're expecting hundreds of pips profit. We have a bull trend, and we have a break below the bull trend line, and we have a lower high. Is this a lower high major trend reversal? I think it's not enough bars. We only have 2 bars down. We only went sideways for about 5 or 6 bars. The resumption up is only 5 or 6 bars. Did not get to the moving average. This is still probably a minor reversal. However, this has a higher probability of success. Now we have a double top lower high major trend reversal. The pullback went sideways to the moving average. It lasted 10 or more bars. This has a higher probability of leading to a swing down. It's a second entry short for the major trend reversal. Most major trend reversals have a 40% chance of leading to a swing trade. That means they have a 60% chance of not leading to a swing trade, 60% chance of either a small loss or a small profit. Minor reversals like this usually lead to a minor sell-off and a trading range. This has a better chance of being major, but this is clearly only a minor reversal. It does not have enough bars to lead to a major reversal. Probably a reversal at this point is going to simply be a bigger trading range. When the leg down is only 2 bars and the sideways move is only 5 or 6 bars, that's not enough selling pressure to reverse a trend. It's enough to create a pause in the trend, a bull flag or a trading range, but not likely to reverse a bull trend. It sometimes will lead to a major reversal, a reversal of the bull trend, but most of the time it will not. It'll lead to a trading range or a bull flag. Trading ranges have lots of minor reversals. We reversed down, we went up, we went down, we went up, we went down, we went up, we went down. These are all minor reversals in a growing trading range. In general, if you're taking this short, you're doing it for a scalp. This short has a better probability of success, but it's 4 consecutive bull bars and a big outside down bar, forcing you to sell very low in the range. It's probably minor, and we're probably forming a triangle. 3 pushes down, 1 pullback, 2 pullback, 3. And then a triangle is a bull flag. Chances are you'll get a bull breakout. On the other hand, here we went sideways for 20 bars, touched the moving average, and we've had a number of decent bear bars, and we have a second entry short. First entry, pullback, second entry, second failed breakout attempt above this high. This has a higher probability to create a major reversal of the bull trend. So bull trend and then reversal into a bear trend. It's still only a 40% chance of having a swing down, but it's a reasonable short. We have a strong bear breakout closing below the low of the past maybe 50 bars, a pair of big bear bars closing on their lows, and then we have a strong follow-through bar, probably going at least a little lower. Here we have a bull trend, and we went sideways for about 30 bars, and then look at these bars right here. There's a gap between the high of the bar and the moving average. This is a series of 3 gap bars occurring 20 or more bars in a bull trend, and therefore late in a bull trend. When you get gap bars, it's a sign that the bears are strong. They're strong enough to put bars completely below the average price. The rally that you get from that usually leads to at least an attempt at a major trend reversal. This is a 5-minute chart of the euro versus the dollar. Because the bears were now strong enough to put bars completely below the moving average, they might be strong enough to take control of the market completely. Here, this doji went below that doji, and then we have a second entry short here. This bar went below that bar. So it's a second failed breakout of this trading range. And we have big tails. The market keeps selling off. Every time it goes up, it goes down. This is a reasonable sell for a higher high major trend reversal. Big buy climax, the strongest move occurring 20 or more bars into a trend, usually is an exhaustive end of the trend and not a measuring gap leading to an even stronger trend up. We're around a measured move target based upon the height of this trading range. The trading range lasted about 40 bars, and we're right at a measured move up. If you want, you can call it a wedge or a failed breakout above a bull channel. Moving average gap bars, measured move up, 3 pushes up, 1, 2, 3, failed breakout above a bull channel. Five bars in a tight trading range with big tails on top. The bulls are not willing to buy up here. Every time it goes up, the bulls sell and the bears sell. That's creating these tails. They are all small reversals down. Whenever you take any trade, you always have to have a plan to get out. Where are you going to take your profits? Here we have a higher high major trend reversal, and you can sell second entry short below this bar. First entry is below that bar. This is a higher probability sell. If you did sell below the low of this bar, you can see the market went down. Your actual risk was to just above the high of this entry bar. It might have been less if you looked at a smaller time frame chart, but this is at most your actual risk from your entry price right here to above the top of that bar. The market never went above that price. Had you had a stop 1 pip above the high of this bar, you would not have been stopped out. That means your actual risk was from your entry price to 1 pip above the high of that bar. The initial risk is from your entry price to maybe this high. You may have initially put your stop above the top of the buy climax. The trader's equation is always positive if you exit with a profit that is 2 times your actual risk. When the actual risk is very small, as it is here, going for a reward that's 2 times your actual risk is usually not good enough. A lot of traders routinely take partial profits at 2 times their initial risk. However, when the initial risk is relatively small, as it is here, if you're looking for a swing trade, it's usually good to hold at least part of your position for a much bigger move. For example, you hold until your premise is no longer valid, until there's a reasonable opposite trade. A lot of traders will scale out. They'll take partial profits once the market reaches 2 times their actual or initial risk. For example, take half off, and then take maybe another quarter off if it goes 3 times your actual or initial risk. And then they'll hold the final piece until there's a reasonably good opposite signal or until the end of the session and the market starts to enter a tight trading range. This is your initial risk, just above the high of the move. Your entry price, 1 times initial risk. You can see some traders took some profits at 1 times the initial risk. It was also a test of the moving average and a test of the top of the trading range, so it's a breakout test. Another target is the bottom of the trading range. At this point, we have a bear channel, possibly a bull flag. Anytime you have a bear channel, you have a bull flag. You might get a bull breakout of the bull flag. You may get a bear breakout below the bull flag. When the channel is very tight like this, the first reversal up will probably be minor, and the market will either continue down or go sideways. A tight bear channel like this is a bear breakout on a higher time frame chart. In this case, we have a bull breakout, and this would be a bear breakout or a reversal on a higher time frame chart. The bulls are trying to get a wedge bull flag. Reversal up, and a third reversal attempt with this bull bar. But instead, we're getting consecutive bear bars breaking below the bottom of the wedge bull flag. Therefore, this might be a measuring gap leading to a measured move down based upon the height of the bull flag. Some traders will use this high for the measured move. Others will use that. If it goes below this target, traders will then look at a measured move based upon the height of the entire bull flag. Reasonable to take partial profits again, or even full profits at a measured move down, either based upon this attempt at a wedge bull flag, 1, 2, 3, or using the top of the swing down. Now we're getting a reversal up. We're starting to get a lot of small sideways bars. We may be entering a tight trading range. It's reasonable to exit longs here. It tried twice to get down to the target, did not reach it. It got to one target from here, tried twice to get to a target using this high and the bottom of the bull flag, and got close to it, and now it's starting to churn up, and now we're going above a bull bar. This is a reasonable location to take your final profits, especially since we're starting to get a lot of small bars and we're starting to go sideways. It might become dead money. The market might enter a tight trading range for the rest of the day. This is a 5-minute chart of the euro versus the dollar. Strong bull trend, and then a very strong reversal down, lasting 10 or more bars, falling far below the moving average. And we have a pair of gap bars. If the bull trend resumes, it probably will lead to an attempt at a major trend reversal. Strong selling pressure, gap bars, bears will look to sell a reversal down from the next rally. Higher high, major trend reversal. Reasonable to take the short. It's a second entry short. It's hard to see, but the market went below this bar and then had an inside bar and then went below that bar. That is a reasonable short, except this is Pacific time. This is the end of the session, and the market often goes into a tight trading range. If you're taking a short like this and you're at the end of the session when it tends to go sideways, you really want the market to fall pretty quickly, which typically does not happen at the end of the session. We have 6 consecutive bear bars, but the bars are small and we're at the end of the session. When the market is at the end of the session, it often enters a tight trading range lasting hours. Therefore, the chance of a swing down, especially when you start to get small bars like this and sideways bars like this, is very small. Chances are the market is just going to stay in a tight trading range for the rest of the day. And since you're really not going to make much money, you can see the height is only 10 pips from here to here, and therefore the bars are only 2, 3, 4 pips tall. It's usually better just to exit. For example, on a reversal up from a bull bar, 2 legs down, 1 pull back 2, or 1 pull back 2. You can see the bears who exited here only made maybe another 2 or 3 pips more than the bears who exited here. Typically, if I took this short, I know it's probably going to go sideways. I'm taking the short hoping for a very big fast reversal down like this, but if I do not get it, I will just try to exit with a small profit if I can. Whenever you're taking a major trend reversal trade, the probability of profit is usually only about 40%. However, if you get a strong breakout and enter after the strong breakout, the probability of a profit is 60%, sometimes more. The trade-off is your stop is usually further away, and there's less reward remaining in the trade. Whenever you take a higher probability trade, you're always going to be taking a trade that has a worse risk-reward ratio. Whenever you take any trade, you should have a plan to take profits when you enter the trade. You can change the plan once you're in, but you always need a plan when you're getting in. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading major trend reversal tops.